Hi, I'm Joe Toth with the Jurgensen Group and Weichert Realtors. The following is a discussion on some of the possible tax implications of short sales and foreclosures. This discussion is not to be considered guidance or advice. All questions and concerns should be directed to your tax accountant or real estate attorney. Did you recently get surprised by getting a 1099-C from your lender and wondering what it is all about? If you didn't get one, is it possible that you should have? In the past year, hundreds of thousands of homeowners have either negotiated a loan modification, had a short sale, or possibly have had their home foreclosed upon. Because of this, the IRS has issued fresh guidance on how to handle canceled mortgage debt during this tax season. Most consumers are ill-informed and do not understand the potential tax liability when a debt is forgiven. When creditors forgive a debt, the forgiven amounts are usually treated as ordinary taxable income by the Internal Revenue Code. However, under a special exemption adopted by Congress covering distressed home mortgages, many owners can escape the taxes because their mortgage went seriously delinquent or they lost their house. For you to qualify for special tax treatment, there are essential tests that you must pass to qualify. The debt your lender canceled must have been used by you to buy, build, or substantially improve your principal residence. Principal residence is the key word. It can't be your second home, an investment condominium, a weekend retreat, or a seasonal home you occupy for less than half the year. It can only be your main residence and fully documented as such. The unpaid mortgage balance as part of a modification, short sale, or foreclosure cannot have been used for non-qualifying purposes, i.e., for something other than acquiring or constructing the house or making capital improvements to it. Refinance mortgage debts used for kids' tuition, vacations, buying cars, or paying off credit bills do not qualify. The IRS offers the following hypothetical example of how borrowers can mess up their chances for tax relief. A taxpayer took out a first mortgage of $800,000 when he purchased a house years ago. Thanks to strong appreciation in property values, the house was soon worth $1 million. The owner then refinanced the mortgage to $850,000. The loan balance at the time was $740,000. The owner used the $110,000 in cash out proceeds to buy a new car and pay off credit card debts. Bad move. What you thought was a smart move has now come back to put the hurts on you. A year or two later, house prices have fallen significantly and your home value has plunged to between $700,000 and $750,000. The owner then persuades his bank to allow a short sale of $735,000 and cancel the remaining $115,000 of unpaid debt. Does the owner get tax relief on the full $115,000 under Congress's special exemption? No way, according to the IRS. The homeowner escapes income taxes on just $5,000 of the $115,000 because he spent the other $110,000 on a car and credit card balances, neither of which counts as a qualified principal resident debt. Taxpayers who walk away from their houses may be liable for taxes if at some point the property no longer was their principal residence. This could happen, for example, if they rented it out for the period between their last payment and the foreclosure, effectively converting the house into rental property, not their principal home. Anyone who has had mortgage debt cancellation as part of a loan modification or foreclosure should go to irs.gov and download Form 982 and IRS Publication 4681 for additional filing detail, or call 800-TAX-FORM to request copies. If you had a mortgage debt canceled but never received a 1099-C from your lender, get in touch and request it if you want to avoid federal tax hassles.